Disclaimer. This video is for educational purposes only and is not financial advice. Always do your own research before investing.
Imagine a world where you don't wait months or even quarters for a dividend. Imagine waking up every Friday morning to fresh cash deposit in your brokerage account, fueled by the most powerful indices on the planet. I'm talking about Friday paycheck that looks more like hyper-growth stock returns, 22%, 35%, or even north of 40% distribution rates. Welcome to the Zero DTE revolution. Today, we are tearing down the curtains on Roundhill's QDTE, RDTE, and XDTE. These aren't your grandfather's covered call ETFs. While traditional income funds are stuck in the slow lane, selling monthly options, these funds have entered the hyper-speed lane of 0 days to expiration. Yes, I'm a big holder of these three ETFs into my registered accounts, mainly Lira and RRSP. Every Friday, I'm receiving the money, I'm reinvesting to make more shares and keep reinvesting and making compounding works in my favor. As you can see, though my net cost basis I'm down, but on my total, after considering all the dividends, I'm significantly up on these positions. Now let's dive in. What are these ETFs and how do they work? Most traditional covered call ETFs like XYLD buy the stock in an index and sell monthly call option against them. Roundhill does things differently. These are actively managed synthetic zero DTE strategies. The first thing to understand is that these funds do not own the underlying stocks in the S&P 500 or Nasdaq 100 directly. Instead, they create synthetic exposure by purchasing deep in the money flex call options. Now, flex options are customizable exchange-listed contracts that allow the fund to pick specific strike prices and expiration dates. By buying calls that are struck deep in the money, meaning the index price is already far above the strike, and fund mimics the price movement of the index almost exactly but with less upfront capital. Zero DT stands for 0 days for expiration. As you can see, the daily harvest cycle, the morning entry at market open or shortly thereafter, the fund manager sells out of the money call options that expire at the end of the same trading day. By selling these calls, the fund receives an immediate premium. Option expire at the end of the day, the position is closed by the closing bell and the cycle repeats the next morning. Here's the overnight advantage. This is a key differentiator. Because the fund sells the call after the market open and they expire at the close, the fund is uncapped overnight. If the S&P 500 gaps up 1% before the opening bell due to positive earnings or economic news, the fund captured that entire move. The upside is only capped during the actual hour the market is open. Now look at the numbers as of today, July 20th. 2026. The total return, which include the price changes plus every distribution reinvested, tells a compelling story. Now, if we compare XDTE to its S&P 500 peers, we see wide ranges of strategies. For example, SPYI uses monthly strategy with tax-efficient laddered options, expense ratio of 0.68%. XYLD, a passive monthly at-the-money strategy, expense ratio of 0.6%. ISPY tracks a daily covered call index but uses a different derivative mix, expense ratio of 0.55%. Then WDTE also use zero DT strategy but focus on selling puts, expense ratio of 0.99%. Roundhill's funds generally have higher expense ratio of 0.95 to 0.97% because they are actively managed and involve high frequency trading. Now let's talk about the pros and cons, the devil's bargain. In a financial world, there is a concept researchers call the devil's bargain regarding derivatives income. The pros: weekly payday check. These funds are designed for immediate cash flow, aiming to pay out distribution every Friday. Volatility risk premium. By selling daily option, the fund seeks to invest the volatility risk premium, essentially getting paid by other traders who are willing to overpay for daily insurance. High win rate. For instance, QDTE has reported a 77% win rate, meaning the calls it sold expired worthless, allowing the fund to keep the full premium on 77% of trading days. Now let's talk about the cons, the trade-offs. NAV erosion. This is the biggest risk. Research shows a strong negative mechanical relationship between high derivative income and total returns. If funds pays out 40% yield but the underlying index only grows 10%, The share price must decline over time to make up the difference. Asymmetric risk. You have full exposure to the downside of the index but limited participation in the upside during the trading days. For example, if the Russell 2000 drops 5%, RDTE will drop nearly as much, less than the small premium collector. Tax complexity. Distributions are often estimated as 100% return of capital. While this isn't immediately taxed as dividend, it lowers your cost basis. If your basis hits zero, all future distributions are taxed as capital gains. Suitability. Who should buy these? These ETFs are specialized tools, not set and forget index funds. These are suitable for income-focused investor retirees. If you need a weekly cash flow to pay bills and are less concerned about the long-term growth of your principal, these are designed specifically for you. Volatility diversifiers. Investors looking to profit that churn rather than just straight bull market can use these to capture a different type of return, the volatile risk premium. This is not suitable for long-term growth seekers. If you are 20 years from retirement, the NAV erosion and high fees will likely cause you to underperform with simple low-cost index funds like SPY or QQQ. Tax-sensitive accounts non-advantage. The constant realization of gain and basis adjustment make these more complex for standard taxable accounts compared to holding them in the registered accounts. Also in Canada, you should be only holding these in a registered account like RRSP or LIRA. Otherwise, there will be withholding tax of 15% charged by the USA government. Now it's time for the final verdict. The opportunity highlights the weekly Friday payouts and the unique uncapped overnight advantage that set these funds apart from traditional covered call strategies. The reality check explicitly warns about NAV erosion and the devil's bargain. The mechanical reality that seeking out higher derivative income typically leads to lower expected total returns. Suitability clearly define the green light for income-focused retirees who need current cash flow and the red light for long-term growth compounders who should prioritize capital appreciation over yield. The Roundhill Zero DTE suits represents a massive shift in how retail investors can access complex institutional strategies. QDTE, RDTE, and XDTE offer some of the highest yield in the market by capturing overnight market moves and selling daily volatility. However, remember the devil's bargain. The more yield on demand today, the less capital appreciation you should expect tomorrow. Use them for income, but always keep an eye on your principal. Thanks for watching. I will see you in the next video.